So I guess the first question here is, what is treasury stock? Treasury stock is when a company has issued stock. So in other words, at some point in the past, you've made the debit to cash and the credit to common stock. And now the company is buying its own stock back off the open market and holding it in its treasury. So when a company buys back its own stock, this is not investing in the stock of another company like we did in Appendix C. This is, now we're in Chapter 11, which is the whole stockholders' equity section. This is the company buying back its own stock. So a few things you need to know. Once a company buys its own stock back off the market, it's called treasury stock. To do this, let's just say it bought 1,000 shares of its own stock at 50. It would debit an account called treasury stock. And the account treasury stock is a stockholder's equity account. And we would say, okay, so 1,000, so that would be 50,000, okay? And we pay cash of 50,000. So treasury stock is not an asset, it's a stockholder's equity account. When a stock is held in treasury, it does not vote, and it does not get any dividends, so we don't have to account for any of that at all. So that keeps things a little bit simpler than they otherwise might be. Okay, so let's just see how some of the accounting works. There's several things a company can do when it buys back its stock, and the usual thing to do is to hold it in its treasury as treasury stock. It does not usually retire it. So all we're going to be doing in this chapter is recording treasury stock and then reissuing that treasury stock. And when we say reissue, it's just selling that same stock out onto the open market again, and it's going to be done at whatever the market price is. So say we reissued these same 1,000 shares at 50, at the same price, we would, in that case, the company would get cash, and they would credit the treasury stock account because they just sold the treasury stock, that they bought. Okay, so that would be one scenario. So this is these are going to be either or, okay? So that would be the simplest one, but the chances of it happening are not that great. Usually the market price won't be that constant on something. So what if we reissued those same 1,000 shares and instead we got 60,000? The market price had gone up. So in that case, we would get the 1,000 shares times 60. We would get $60,000. Now the treasury stock comes on and off the books at what it was initially purchased at. So this $50 becomes the cost base of that stock. So when we get this cash here, this is at the market price of 60 times the 1,000 shares, right? But this treasury stock is coming off the books at what we paid for it, the 50 times the 1,000 shares. So it's coming off at 50. Now, here's where we get to the part where there are no gains or losses recognized on treasury stock transactions. It would be like buying and selling from yourself, because these are owner transactions. So what we use to reflect differences between, what we paid for it and what we sold it for, we're going to use a paid-in capital treasury stock account. Okay, so paid-in capital and treasury stock. And in that case, it would end up with a balance of $10,000. Okay, so we can buy the stock off the market, the company's own stock. We can reissue it at the same price, or here's what happens when we issue it at a higher price. What happens if we reissued it at a lower price? In this case, say we only got 45 when we reissued it. Well, then we'd have 45,000 in cash. The treasury stock is still going to come off the books at what we paid for it. So the treasury stock is still going to come off the books at the you know, the $50 times the 1,000 shares, okay? So it would come off at 50, and in this case, we would be having to debit the paid-in capital treasury stock account. Okay, so that's the basics of it. I mean, that's all fairly straightforward. What I'd like to do is sort of move on to an example that will show you a little bit more how that works, and we'll also show you how the paid-in capital treasury stock account works, because the paid-in capital treasury stock account cannot go below 0. So we have to keep that in mind when we're doing treasury stock transactions. So if you want to follow along the notes, let's say we bought treasury stock, the 1,000 shares, at 50. So that would, we're going to, I'll put this here so we don't lose track of what we're doing. Whoops, we buy, 1,000 shares at 50, and that's going to be the cost base. So now we've got treasury stock of 50,000. So now we're going to just sort of follow this through in sequence. We're not going to resell all the shares. Maybe the company decides to reissue or sell 200 shares at 60. So now we're going to reissue 200 of those shares at 60. Okay, so we can do this. So we would get cash, and the amount of cash we would get would be the 200 times the $60 per share. Okay, so that comes out to 12,000. Those 200 shares of treasury stock would come off the books at the 200 times 50, which would come out to 10,000, which would mean we would have paid in capital treasury stock of 2,000. So when you're doing these problems, it's a good idea to set up a T account for the paid in capital treasury stock, because that account cannot go below 0. All right, so right now it's got 2,000 in it. So let's see what happens next. Now maybe we reissue some more stock at $45 a share. So we're going to reissue some more of this stock, 200 more shares, but at 45. Okay, so we're going to get cash, be the 200 times 45, which I believe comes out to 9,000. We would take the treasury stock off the books. Oh, wait a minute. To plan ahead a little bit here. We take the treasury stock off the books, and that comes off at what we paid for it, which is the 200 times 50, which in this case comes out to 10,000, just like it did up here. Except now we've got to reduce the paid-in capital treasury stock, so we're going to be debiting paid-in capital treasury stock for the difference. Okay, so now I'm going to put that over here. We've got a $1,000 balance in the treasury stock account. All right, one more transaction here. Let's see what happens. Okay, so now we're going to sell or reissue 200 more at 40. Okay, things are getting a little rough here, so we're going to go cash, and it's going to be the 200 shares times 40. So we're going to get, what, 8,000. The treasury stock, okay, I'm going to be, instead of abbreviating here, the treasury stock is still coming off the books at 10,000. So we're going to have to debit our paid-in capital treasury stock, but we've got a difference of 2,000 here. We only have 1,000 here, so we can only take 1,000 more off because this account cannot go below 0. So we can only debit that 1,000. And so when this unfortunate situation happens, we have to use the retained earnings. We're going to debit retained earnings or the difference. Oh, goodness, okay, 1,000. All right. So the paid-in capital, treasury stock cannot go below 0, so that's a good rule to remember. Use the T account, and yeah, that's really about as bad as the treasury stock gets. Okay, so we can move on to our next adventure.